It's time for Stock Picks. Today we take a closer look at the insurance sector with Outsurance, Momentum and Old Mutual. Joining us to take us through the performance and what has been driving profitability is Ndumiso Ndebele from Matrix Fund Managers. Ndumiso, thanks so much for your time this afternoon. So you're bullish on the local insurance space. Before we get into the picks, maybe just walk us through why you're currently seeing value there.
So thanks for having me. So to say that I'm bullish is kind of an overstatement, as I will actually talk about the valuations later.
Okay.
But I think what has been quite interesting is the fact that they've relatively outperformed the domestics, so SAN. So if you look at the drivers of performance in the markets, it's been the likes of in the precious metal space, the gold,
Yes,
as well as platinum, as well as Naspers. But your SA Inc. has been down. If you look at retail, it's down more than 20%. And yet the insurers have held up relatively better, with some of them actually posting at least double-digit year-to-date returns. So that was quite an interesting dynamic, and that's
okay.
why I wanted to actually hone in as to what has been the drivers. So if you look at the insurance space in general, if I start with the non-life insurers, so those who insure property as well as motor, so the post-COVID period created a profitable anomaly for the South African non-life insurers. So initially, there were idiosyncratic events like load shedding causing power surge claims, as well as the July 2021 riots that led to substantial property losses for the insurers. So meanwhile, what you find for the global reinsurers, so these are the insurers that insure insurance companies, were forced to increase their rates post the pandemic due to post-pandemic inflation, which was eating into their margins, and they needed to actually rebuild their solvency. So, and as a result, they had to pass on higher premiums to the insurers, which with the insurers in the SA market pass it on to the consumers overall. So this price hike that actually came into the consumers coincided with a dramatic improvement in the local claims environment. So what happened is load shedding actually eased, and weather-related claims were quite low. If you look at rainfalls as well as flooding or hailstorms in Gauteng, they actually didn't appear in the last 24 months. So in your motor sector, the claims frequency has been quite benign as well due to these weather-related events being benign. So the combination of higher premiums and lower claims significantly boosted the profitability of the insurers. That benefited the likes of Outsurance as well as Santam.
All right.
So if you look at, yes.
Yes, then let's get into that. Let's get into Outsurance in particular. You mentioned that, a lot of these companies posting double-digit growth. And if I remember correctly, I think Outsurance earnings were up over 30%. Also keeping investors quite happy, declaring the final dividend as well as a special dividend in the last financial year. Let's start there. Take us through your analysis of Outsurance.
So Outsurance, they have the South African direct lines business, as well as they have the Australian business called UE. So what has been happening globally and in the market, there's various debates as whether it's due to climate change, etc. But in Australia as well as in South Africa, you had benign claims. So normally insurers, when you have weather events like hail or storm or cyclone events, that normally happen in the likes in Australia. So relative to what they'll normally have claimed, so they'll normally post around about the higher 50% relative to their premiums in terms of claims, and they're currently printing numbers 40% and below. So, and as a result, so in the insurance space, if you have lower claims relative to your history that you priced in your premiums, then you boost your profits. What it actually coincided is, if you look at the number of policies, particularly in SA for Outsurance, it hasn't grown. So the premium growth that have been actually showing is they're actually pushing price increases to the consumers. And that has been a dynamic that has happened across the market. So if you actually receive a premium increase coming through from Outsurance, it doesn't mean that you actually benefit by switching to the likes of Maui or
Yeah.
Naked, etc., because they are also increasing the premiums. And the global insurers are actually passing on price increases to them. And as a result, we've seen the whole industry actually pushing through these price increases in an environment where claims were actually quite benign. And as a result, their profitability were actually boosted. And it's the same dynamic as well as in Australia. So this has been a global dynamic that has boosted the likes of Outsurance and the others.
And I wonder how much power they have, when it comes to the pricing power and pushing through those increases in their premiums, especially in an environment here in South Africa where consumers are under pressure. But then you are mentioning that consumers then don't have a choice because all the other insurers are doing the same thing.
Yes, so I think like the life insurers have been hurt. If you look at the 2022-2023 period, when you had hailstorms, the flooding in KZN as well. So they know the consequences of trying to take market share that will tend to be not profitable. So they have been quite disciplined in actually ensuring that their margins are quite boosted and their solvency overall is quite boosted by actually pushing through these price increases. So the debate in the market now is, are they actually going to decrease prices and try and actually scale up and grow market share? It's a debate that is out there, but the global reinsurers are actually passing on these price increases to them. So it's still a debate as to whether how are they going to
navigate that sort of environment. Yeah, I wonder if they're not also just pushing people out the market. You get what I mean? And perhaps people might not be insuring their products, their items as much anymore. But let's move on to your second pick, right? Delivering blockbuster results, momentum that is. I think it was another record year of earnings. Let's get your analysis on that one.
And before I get to that, so it's when it comes to lapse in insurance, you know how South Africa, so you have your mortgage, etc. Then you have to have your home actually having insurance.
Yes.
And similarly, when it comes to your finance on your vehicles, you are required to actually have insurance. So the consumers overall, they don't have a choice, and hence why they continue actually paying their premiums, and perhaps the one that will be like not benefit from it is perhaps the discretionary retailers, as what we've seen.
Okay.
But going back to the likes of Momentum, so these are the life insurers that have experienced various tailwinds in the market. So when you look at a life insurance policy, you have actuaries that actually set assumption on mortality rate as to what like the death claims that they'll expect. And post the pandemic, we know that we had the COVID period and we had excess debt in SA, and there was a lot of benefit relative to what they've assumed that was paid out during COVID. So on policies that were renewed, they had to actually strengthen their assumptions. So assuming mortality rates will be higher relative to the pre-pandemic level. And then again, that actually coincided with a claims environment within your mortality being lower than what is expected. So the difference between what is assumed relative to the actual claims is booked as profit. Another dynamic that happens for the life insurers is that when you have these long-term liabilities, just think of someone that has taken life insurance policy in day 23, and then you assume that that person is going to die when they are 75 to 80 based on lifestyle in SA in general, the actual assumptions. So you need to hedge those liabilities. So you cannot use only bonds, so you also use equities. So, but if you look at the robust performance of equities and bonds year to date, it has been quite impressive, which has actually boosted the profitability of the insurers. So relative to what they've assumed in terms of market returns, which is normally around 9 to 10%, and given what bonds and equities have done, they are booking those profits, and that's what they'll call investment variances. And then insurers also actually sell products that are market linked, and they earn a fee on those as a percentage of the value of those products. And given the rising market, this has increased the fees on the insurers. So this robust profitability in the life operations combined with provide positive results as well, given that they also own non-life subsidiaries, has allowed them to actually significantly outperform the struggling sectors like retail.
All right.
And these have been offset as well by poor persistency. So within the life insurance space, we have seen people, especially in the funeral space, where they're actually lapsing their policies because of the economic pressures. But what has been happening with regards to mortality as well as the investment gains has largely offset that, and hence why the profitability has been quite resilient relative to the other SAN.
All right, we unfortunately have to leave it there. We definitely need to get you back on so we can continue the conversation. We still had to cover Old Mutual, but run out of time. Ndumiso, thanks so much for your time and your analysis this afternoon. That was Ndumiso Ndebele from Matrix Fund Managers.